The pickup truck market is supposedly collapsing. Buyers are rejecting huge monthly payments. More owners are trapped in loans they cannot escape. Dealers are increasing incentives and repossessions are getting more attention. By normal economic logic, this should create one obvious result: cheap trucks. But open any dealership website and look for a clean 3-year-old pickup. You will still find prices of $40,000, $50,000, and even $60,000. So where are all the bargains? Here's the answer. A distressed truck can become cheaper at one stage of the market without ever becoming cheap for you. Between the struggling owner and the retail buyer, that truck passes through a lender, an auction, a dealer, and thousands of dollars in additional costs. And the first reason begins with a number hidden inside the loan: negative equity. Imagine someone buys a new pickup for $80,000. They make a small down payment and finance the rest for 84 months. 2 years later, the truck is worth $52,000, but the owner still owes $65,000. The truck is worth $52,000. The loan balance is $65,000. That creates $13,000 in negative equity. Now imagine the owner can no longer comfortably afford the payment. The obvious solution seems simple: sell the truck. A private buyer offers the full market value of $52,000. But the bank still holds the title, and it will not release that title until the $65,000 loan is paid off. That means the owner must bring another $13,000 to complete the sale. Someone struggling with the payment probably does not have $13,000 sitting in cash, so the owner cannot sell the truck cheaply. They cannot even sell it for its fair market value without first paying off the difference. This is not a rare situation. In the first quarter of 2026, almost 31% of trade-ins used toward new vehicle purchases carried negative equity. That means nearly 1 out of every 3 trade-ins in that group was worth less than the remaining loan balance. And that changes how distressed trucks enter the market. Instead of being listed privately at huge discounts, many owners remain trapped in the loan. Some roll the negative equity into another vehicle. Others continue making payments for as long as possible. And when the payments finally stop, the lender may repossess the truck. This is where many buyers expect the bargain to appear. The bank now owns the vehicle. Surely it wants to sell quickly. Surely that means someone will get a cheap truck. And someone often does. But that someone is usually not the final retail buyer. Many repossessed vehicles move through wholesale auction channels. The truck goes from the borrower to the lender, from the lender to an auction, and from the auction to a dealer. Only after that does it reach the public. So let's follow the money. Suppose an $80,000 truck is repossessed after a few years. At the wholesale auction, a dealer buys it for $39,000. That sounds like the crash everyone was waiting for. But $39,000 is not the dealer's final cost. The auction and buyer fees add around $1,000. Transportation adds another $700. An inspection reveals worn tires, damaged brakes, and several cosmetic problems. Repairs, tires, detailing, and reconditioning add another $3,000. Now the dealer has $43,700 invested. Then come financing costs, insurance, advertising, employee expenses, and the cost of keeping the truck on the lot. Before earning any profit, the dealer may have more than $44,000 tied up in that vehicle. The dealer then lists it for $48,000 or $50,000. The truck was cheap briefly. It was cheap at the wholesale stage. But by the time you see it online, the wholesale discount has been replaced by fees, repairs, overhead, risk, and dealer margin. Wholesale distress does not automatically create retail affordability. There is another problem. Not all used trucks are equal. When you sort online listings from the cheapest price upward, the apparent bargains often come with a reason: a salvage title, a rebuild title, major accident history, extremely high mileage, mechanical problems, or a configuration very few buyers want. These trucks may be cheap, but many banks will not finance them easily, and many buyers do not want the repair or resale risk. The clean title trucks are different. A late model pickup with reasonable mileage, a clean history, and a popular trim attracts buyers, dealers, and lenders. Those trucks receive stronger bids at auction because everyone knows they'll be easier to resell. A market can contain a large number of trucks while still having a limited supply of the trucks people actually want. More inventory doesn't always mean more desirable inventory. and expensive new trucks continue supporting used prices. In early 2026, the average transaction price for a new full-size pickup was still above $66,000. So a 3-year-old truck listed for $46,000 may look expensive compared to the past, but compared to a new truck at $66,000, it appears to offer a $20,000 discount. That price gap pushes many buyers towards used trucks, and that demand helps keep clean used trucks expensive. This is why the word collapse can be misleading. Truck sales can slow, dealers can carry vehicles for longer, manufacturers can offer larger incentives, more borrowers can become trapped in negative equity, and repossessions can rise. All of those things can happen without retail prices falling dramatically. In fact, wholesale used vehicle values in mid-June 2026 were still higher than they had been 1 year earlier. That's not what a traditional price collapse looks like. The market is under pressure, but pressure is not the same as cheap. For trucks to become genuinely affordable again, several things would need to happen at the same time. Clean used truck supply would need to rise faster than buyer demand. Wholesale auction prices would need to fall for a sustained period. Dealers would need to accept smaller margins or real losses. Manufacturers would need to reduce actual transaction prices, not simply advertise temporary incentives. And new entry-level trucks would need to return at prices ordinary buyers can comfortably finance. Until then, you may see discounts without seeing genuinely cheap trucks. A $5,000 rebate on a $70,000 pickup still leaves you with a $65,000 pickup. A lower monthly payment created by extending the loan does not make the truck cheaper. It only makes the debt last longer. And the repossessed truck purchased cheaply at auction does not guarantee that the final buyer receives the same discount. So is the pickup truck market collapsing? For some owners, absolutely. The person who paid $80,000, owes $65,000, and owns a truck worth $52,000 is experiencing a personal financial collapse. But the lender can recover part of its money. The auction collects its fees. The dealer adds repairs, costs, and profit, and the next buyer still sees a normal retail price. That's why you can't find the cheap truck everyone keeps promising. The losses are real, but they are being absorbed by the previous owner before it ever reaches you. The market may be collapsing for the person who overpaid. It just hasn't become a bargain for the person waiting to buy. So here's the real question. How much would a clean 3-year-old pickup need to cost before you would finally call it cheap? Drop your price in the comments and subscribe to Math Invests for more simple breakdowns of the hidden math behind the things people buy, finance, and struggle to afford. The market may not be giving buyers a bargain yet, but understanding the math can stop you from becoming the person who absorbs the loss. Thanks for watching.